Welcome to the Three Edge Week in Review for the week of February 28th. I'm Fritz Folts, the Chief Investment Strategist here at Three Edge, and joining me here today, once again, is Steve Cucchiaro, CEO and Chief Investment Officer here at Three Edge Asset Management. Today, along with a quick recap of activity in the global markets, Steve and I will be discussing how and why the level of economic and market uncertainty is so pronounced, and we'll discuss investment decision-making under conditions of heightened uncertainty. First, a quick look at the markets, and as the war in Ukraine escalates, equity markets continue to struggle, while the price of real assets, such as commodities and gold, have increased dramatically. Crude oil is currently over $110 per barrel, and prices for agricultural commodities have spiked higher since, for example, as I mentioned last week, over 30% of global wheat production is supplied by Ukraine. Equity market volatility remains elevated, with the VIX volatility index at over 30, as investors struggle to understand the potential impact that the crisis in Ukraine could have on inflation, global economic growth, and Fed policy, all of which are interconnected. And the war in Ukraine has not made the Fed's job any easier, as it seeks to normalize monetary policy and raise short-term interest rates to combat inflation, currently running at levels not seen in over 4 decades. Last on Friday, the non-farm payroll report provided the strongest reading since last July, and the unemployment rate actually declined to 3.8%, which is very close to the pre-pandemic lows. The strength of the labor market should keep the Fed on track to raise interest rates at the next FOMC meeting, which takes place in the middle of this month. So let me bring Steve in here. And Steve, as we know, investing is about seeking to make good decisions under conditions of uncertainty. And it certainly feels as though the current level of uncertainty in the market is quite elevated. And it feels like the situation could go any number of directions. So first, why don't you speak to why the current environment just is so uncertain?
Well, I have to say, Fritz, in my lifetime, it's hard to remember wider disparity between some of the most pessimistic scenarios that could unfold and some of the more optimistic scenarios. Uh, there's talk about how maybe we get out of this, maybe there's a negotiated settlement in Ukraine, however unlikely, but that would certainly cause a big change in the markets. And on the other side, the unthinkable is starting to become a little bit less unthinkable. There's talk about the potential that this is the beginning of World War III and discussion of tactical nuclear weapons. And so the disparity is just very, very strong. So my advice is that in times like these, it's important to not get too locked into any one scenario as though it were guaranteed to happen, but to recognize that the outcome over the next few days, weeks, or months and how that evolves will depend on decisions made by people that haven't happened yet.
Right. So it's, well, I'll tell you, as we're only in the third month now of 2022, but it certainly feels as though last year, as though 2022, that was a long time ago. And, markets are obviously behaving quite differently than they did last year. So I think it could be a good idea to focus a little bit on, how oftentimes when people talk about the global capital markets or the markets, people think that that means only stocks and bonds. But as we know, there are a multitude of asset classes that make up the totality of the markets. And by casting a wider net, investing in different asset classes, you can better manage risk or potentially enhance returns over the long term. So maybe perhaps you could dig into that and talk about how it's helpful to understand the wide array of asset classes that actually do make up the global capital markets.
Well, Fritz, you're right. In 2022 so far, if your investment portfolio only consisted of stocks and bonds, then there are very few places to hide, and it's likely you're not doing so well. However, by expanding your investment universe, one can often find asset classes that move in the opposite direction of stocks and bonds, particularly during periods of rising inflation. It was true in the 1970s, and it's very true so far year to date. Now, I'd like to show on the accompanying table that you can see that while stocks and bonds are down substantially year to date, commodities and gold are up sharply. So not all markets are down this year.
Excellent. So let's talk now a little bit about, from your standpoint, what does it take to be a successful long-term investor, particularly when you're confronted with these periods of heightened uncertainty like that we're experiencing right now here in 2022?
Well, I really believe it's important to stay flexible and never to be overconfident. It's important not to become myopic, counting on only one scenario that could possibly happen, given that there is a range of possibilities. And research has shown that investors often are known to have a limited imagination. You get locked into one scenario, think that's the only thing that could happen, and then you could get blindsided. But at the same time, that doesn't mean that you just roll the dice. It's not a time to just cop out or be intellectually lazy. What it means is that you need to synthesize all the available relevant information in favor the most logical outcomes, while at the same time hedging against more extreme possibilities. And so I have to say that on our investment committee together and with our other members, having the three edge research model, which does exactly that, it synthesizes what we believe is all the relevant information, has been very, very helpful. Now, we've seen even this year, even though the markets are down, there have been some sharp bear market rallies. And it's a sign that there are still plenty of optimistic investors. They're going in and buying the dip in equities, which worked very well over the last couple of years. However, these investors should recognize that the extraordinary monetary stimulus that was produced over the last 2 years, by our measure, caused a highly overvalued market and pulled several years of investment returns from the future into the present. So even when we have these bounces, one should realize that the upside is perhaps limited. So while it's important to have some exposure to equities, and hoping for those optimistic scenarios to play out, it's certainly a time to protect your downside, given what's happening with real assets like gold and commodities, with tips that are inflation protected, floating rate treasuries, and U.S. cash. And these all represent hedges against geopolitical uncertainty, the threat of stagflation when we see growth potentially slowing in the future while inflation continues to go up, and the Fed, which has been acting in an extraordinarily slow and cautious manner in responding to inflation. So just to sum up, Fritz, I would say that portfolios with meaningful allocations to real assets, to tips, to short duration treasuries have held their own year to date far better than more conventional stock and bond portfolios.
Excellent. Great. Thank you very much for sharing your insight into investing in, what is clearly a very uncertain environment. So that will do it for Steve and me. Remember, all of our videos are available on our 3Edge YouTube channel. And in addition, you can always find not only our videos, but also our written commentaries on our website, which is 3edgeam.com. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.